Meet Sarah and meet Priya. Same city, both 36 years old. Sarah makes $74,000 a year working in operations. Priya makes $71,000 as a project coordinator. Almost identical income, almost identical job title, same rent range in the same neighborhood. But Sarah's net worth right now is $4,000. Priya's is $312,000. Same income bracket, same tax bracket, roughly the same monthly take-home pay, and yet a $308,000 gap between two women who, on paper, look like they're living the exact same life. And when you actually sit down and compare their bank statements line by line, the difference isn't one big decision. It's not a house Priya bought and Sarah didn't, and it's not an inheritance. It's 8 small, completely ordinary purchases that Sarah makes every single month without a second thought, and Priya simply doesn't. Today, we're going through all 8 of them, exactly what they cost when you run the real compounding math, not the sticker price, and what wealthy households consistently do instead. By the end of this video, you're going to know exactly which of these 8 you're still making right now. And before we start, I want to be clear about something. This has nothing to do with being bad with money. Sarah budgets. She has an app, she checks it. She's not reckless, and she's not stupid. None of these 8 purchases feel like mistakes in the moment you make them.
They feel completely normal. They feel like just how adult life works. That's precisely why they're so effective at quietly draining future wealth before it ever gets the chance to build any momentum at all. There's a reason these 8 specifically slip past almost everyone's radar. Each one on its own is small enough to be completely defensible. Nobody sits down and decides to forfeit $500,000. They just decide one Tuesday that the lease is easier than saving up for a car outright, that the coffee is a small treat they've earned, that the subscription probably isn't worth canceling for $12 a month. Every individual decision survives its own internal cost-benefit test. It's only when you line up all 8, month after month, year after year, that the real number appears. And by then, it's been running quietly in the background for a decade. A 2023 Federal Reserve survey on household economic well-being found that a majority of adults with incomes above $75,000 still reported living paycheck to paycheck at least occasionally, which tells you this isn't an income problem nearly as often as people assume. It's an allocation problem, hiding inside habits nobody has ever actually priced out.
Number 1, the brand new car on a loan or a lease. Sarah leases a new SUV every 3 years without fail. Her payment is $612 a month, plus insurance that runs higher because the vehicle is newer and more expensive to repair. Priya drives a 5-year-old Camry she bought outright with cash for $14,000 and is driven for 4 years with basic maintenance. Here's the real number most people never calculate. A new vehicle loses roughly 20% of its value in the first year alone and closer to 60% over 5 years. Sarah's $612 a month isn't simply a bill. It's $7,344 a year flowing directly into an asset that is actively losing value every single month she owns it. If that same $612 a month went into a low-cost index fund, earning the historical average of 8% instead, over 20 years, that becomes roughly $362,000. Rich households don't necessarily avoid nice cars. What they avoid is financing depreciation on a rolling, permanent basis.
Number 2, the daily coffee and bought lunch. Sarah spends about $14 a day between a coffee shop drink and a bought lunch 5 days a week at the office. That works out to $280 a month, or $3,360 a year. It feels like nothing because it's never one purchase you notice. It's 50 small ones scattered across a month, each one individually invisible. Invested instead at 8% annually,
That same $3,360 a year becomes approximately $166,000 over 20 years. Priya isn't skipping coffee out of deprivation or self-punishment. She batch preps lunches on Sunday afternoons and treats a coffee shop run as an occasional small pleasure rather than a daily default setting.
Number 3. The premium streaming and subscription stack. Sarah currently has 6 active subscriptions running, several she has genuinely forgotten she's paying for. Streaming services, a gym membership she visits maybe twice a year, a meal kit box she barely opens anymore. Combined, that's $187 a month leaving her account automatically. Priya has 2 subscriptions total, $24 a month. The difference is $163 a month, or $1,956 a year. Over 20 years invested at 8%, that gap becomes roughly $96,000. Subscriptions are specifically engineered to be invisible once you sign up. Frictionless entry, deliberate friction on the way out. That's not an accident. That's the entire business model. Number 4, buy now, pay later on non-essential purchases. Sarah routinely uses installment plans for clothes, gadgets, even concert tickets. And it feels harmless because each individual payment is small. $40 here, $60 there, spread comfortably across a few weeks. But she's currently carrying $2,100 across 4 different active plans simultaneously. And industry research suggests roughly 30% of buy now, pay later users have made at least one late payment that triggered a fee or added interest. Priya either pays for discretionary purchases in full upfront or simply skips them if she can't. The real cost of buy now, pay later isn't really the item itself. It's that it pulls future income forward into the present, which quietly means there's less room left over for saving later, month after month. Number 5, the credit card minimum payment. Sarah carries a rotating balance and pays the minimum most months, roughly $340 a month against $9,800 owed at 22% APR. At that pace, she'll pay approximately $7,900 in pure interest before the balance is ever cleared, and it will take her more than 11 years to get there if nothing changes. Priya pays her card in full every single billing cycle without exception. 0 interest paid every month for years. The card is a convenience tool for Priya. For Sarah, it's a slow, compounding leak working against her instead of for her. Number 6, extended warranties and insurance add-ons on low-cost items. Every time Sarah buys electronics or appliances, she adds the extended warranty at checkout, almost automatically, typically 15 to 20% of the item's total price. On a $1,200 laptop, that's another $200 to $240 layered on top. Extended warranties are consistently one of the highest margin products retailers sell, specifically because most buyers never file a claim large enough to justify what they paid for the coverage in the first place. Priya self-insures instead. She keeps a small, dedicated buffer inside her savings account rather than prepaying a retailer for protection on relatively low-cost items. Consumer advocacy groups have consistently found that extended warranties on electronics under $2,000 rarely pay out more, on average, than they cost, which is exactly why retailers push them so hard at checkout instead of simply pricing the risk into the product itself. Number 7, lifestyle matching after every raise. This is the quiet one, and it's genuinely the hardest to see happening in real time. Every time Sarah gets a raise, her spending rises to match it within a few months. A nicer apartment, a nicer car eventually, noticeably more takeout during the week. Her actual savings rate has stayed pinned near 2% for 6 straight years, despite 3 separate raises during that same window. Priya banks at least half of every raise before she allows her lifestyle to catch up to the new number at all. Same raises, same years, completely different financial trajectory.
purely because Priya decided in advance that the increase belonged to her future self before it ever touched her day-to-day checking account. This is the one that quietly runs underneath almost every other item on this list. Every time Sarah's income moves up, all 7 of the other purchases have a little more room to expand right alongside it. The lease gets a little easier to justify, the subscriptions get a little easier to ignore, the minimum payment feels a little more manageable even though the balance never actually shrinks. Lifestyle creep doesn't just cost money on its own, it raises the ceiling on everything else on this list at the exact same time.
Number 8. Paying full retail because of pure convenience. Sarah buys almost everything at the exact moment she wants it, full price, same-day delivery, premium shipping tacked on, without really thinking about it. Priya waits when she reasonably can, buys secondhand where it genuinely makes sense, and times bigger purchases around known sale windows. On a rough, conservative estimate, Sarah overpays by around $2,400 a year across furniture, electronics, and clothing compared to Priya's approach to the exact same categories of spending. It isn't that Priya loves waiting for things. It's that she's decided most purchases simply aren't urgent enough to justify paying a premium for speed.
Now, let's add all 8 of these together and see the real number. New car financing, $7,344 a year. Coffee and bought lunches, $3,360. The subscription stack, $1,956. Credit card interest, while that balance persists, roughly $2,600 a year. Extended warranties, call it $300 a year on average. Lifestyle creep after raises, hard to price with precision, but conservatively another $2,000 a year in avoidable spending. Full retail convenience premium, $2,400. Add it all up, and you get a total avoidable outflow north of $19,900 every single year. Invested consistently at 8% annually, that number becomes approximately $455,000 over 20 years. Say that number back slowly because it's worth sitting with for a second. $455,000. Not from a windfall Priya received and Sarah didn't. Not from a higher salary, a bonus, or a lucky investment pick. Purely from the space between 8 ordinary monthly habits compounded quietly for 2 decades while nobody was watching. Sarah is not earning less than Priya. She is forfeiting nearly $500,000 of future wealth through 8 ordinary purchases that each, taken completely on their own, feel entirely reasonable and defensible in the moment.
That's the actual trap hiding underneath all of this. No single one of these 8 things would ruin anyone on its own. And that's exactly the point. It's never one dramatic decision that shows up clearly on a bank statement. It's 8 small ones, running quietly in the background of an ordinary month. None of them individually alarming, all of them compounding against you at the exact same time. This is also why Sarah doesn't feel poor day to day. Nothing about her life looks like financial distress from the outside. She has a nice apartment, a nice car, a full closet, and a phone full of restaurant photos. The wealth isn't visibly missing. It's just never been given anywhere to go. Every dollar that could have compounded into her future instead went toward maintaining the appearance of a life that was already technically affordable without any of these 8 things attached to it. That's the part personal finance content rarely says out loud. You don't need to feel broke to be quietly forfeiting almost $500,000. You just need 8 ordinary habits and enough time for compounding to notice them. So here is what to actually do about it, in order. Step 1. Pick the 2 items from this entire list that are costing you the most right now, and fix those 2 first before touching anything else. For most people watching this, that's the car and the credit card balance, because those 2 alone can represent well over half of the total annual leak we just calculated.
Step 2. Automate the difference immediately. The moment you cut a specific cost, move that exact dollar amount into an investment account the same day before it ever has the chance to quietly become something else in your checking account. Step 3. Give lifestyle creep an explicit rule going forward. When you receive a raise, bank at least half of it before you take on any new recurring monthly commitment of any kind. Step 4. Revisit your subscriptions and warranty add-ons twice a year on a fixed calendar date, not whenever you happen to remember to look. Step 5. Before any non-essential purchase over $100, wait 24 hours and ask one specific question. Would I still buy this at full price with no delivery speed attached? If the honest answer is no, that's usually the buy now, pay later instinct talking, not an actual need. This single pause, applied consistently, is often enough on its own to eliminate most of item 4 and a meaningful share of item 8 without any willpower left over for the rest of the list.
Sarah and Priya aren't different people in intelligence or in income. Priya simply made these 8 decisions once, years ago, and then let them run quietly in her favor ever since. Sarah's autopilot has been running quietly against her for the exact same number of years. The genuinely good news here is that autopilot can be reset at any age, starting today with the very next paycheck. If you recognized yourself in 2 or 3 of these 8, that's not a failure on your part. That's simply the first honest look most people never actually take at their own numbers. Most people can name their salary down to the dollar and couldn't tell you within $5,000 what these 8 categories cost them last year. And that gap between the number you know and the number that's actually running your financial life is where almost all of this hides. Priya isn't smarter than Sarah. She just happened to price these 8 things out early enough for compounding to have 2 decades to work with instead of 2 years. That's the entire difference sitting between a $4,000 net worth and a $312,000 one at the exact same age on the exact same income. So which of these 8 hit closest to home for you? Tell me exactly which one in the comments below. And if this video made you rethink even a single one of these habits, subscribe to The Real Numbers Show, because we break down the hidden math behind the financial decisions you make every single day.